Hey everybody, Eric Sandstrom, NMLS 805941. Today we're going to be talking about the good, the bad, and the ugly. I asked my social media friends, family, clients what their questions were in regards to the current state of the real estate market. And I wanted to go over each and every one of those questions and add a couple things in as I promised you guys the video. So let's kind of dive into a couple things that are not asked within the comments first and foremost. One thing that I wanted to bring your attention to is this right here. Mortgage apps have declined 6.5% to a 22-year low. We have not seen this in a while. A lot of buyers are being hesitant to get into the housing market, purchase a home for the first time. And then same thing with repeat buyers as well as refinances. Okay, so a lot of this decline relates to refinance volume because that no longer exists. Okay, so mortgage applications decline. How does that impact, what's going on in the market? Less offers on properties, so on and so forth. The other thing that I wanted to teach you guys, because the feds have been obviously have the Fed meetings and things like that where they've increased interest rates by 0.5%, 0.75%, and so on and so forth. What does that mean with the mortgage rates? How does that directly impact the mortgage rates? So it doesn't directly impact mortgage rates, but it does correlate to them somewhat, some way, shape, or form. But what I wanted to teach you guys is how to determine whether or not rates mainly go up or down. And what I do to do that is I take a quick look at cnnmoney.com or cnn.com/business. What I'll do every morning is go to this button here called the markets. You can see my mouse. Click the markets. This kind of give you a good idea of what's going on. You've got the Dow, the S&P 500 up here. But then down beneath this, you should have the bond rates. You see the bond rates here? Okay, so this is going to show you what's going on with short-term financing as well as long-term. So what we want to focus on for long-term rates, which are mortgages, is the 30-year Treasury. What's going on with that? Today it's at 3.28%. We are seeing it decline. We did see a pricing improvement today for interest rates as we have for the past couple days. Okay, once the Fed meeting occurred, the interest rates actually went down, and the reason they went down is because most lenders baked in what's called risk and increased interest rates artificially because they weren't sure what the Feds were exactly going to do. With the Feds increasing the 0.75 basis and fighting inflation a little bit harder, but not to the extent which I think they should be, I believe that did affect mortgage rates and they went down. They didn't go too far down. They did recover from the Monday hit and might be a little bit less than that today. I haven't priced out a loan. Okay, so that's what's going on with the market, and watch this 30-year Treasury. That'll tell you what rates are going to do for our specific market. Okay. All right, so let's start getting into questions. And then there was one thing that I wanted to add at the end, which shows affordability for mortgages from way back in 1990 in comparison to now, and what income you'd have to show to qualify for a house back then as well as now. Okay, so let's start with like I said, the good, the bad, the ugly. And we've got quite a few of my friends commented on here, clients, things like that. So let's just get jumped in right into it. So Danielle asked different loan types that we will see emerge: ARMs, interest only, longer than 30-year, or assumable mortgages. So to answer your question, Danielle, ARMs have already come out. At least with our bank, we have identified a lack that Fannie Mae and Freddie Mac are not really doing. Fannie Mae and Freddie Mac ARMs are almost impossible. the fixed rate pricing ends up being better unless you're willing to pay a huge amount of points in order to get an ARM. So what we've done is we've launched a 7-year ARM, a 5 and a 7-year ARM that can help bridge that gap from what Fannie and Freddie is doing, and the rates are actually pretty good. If you want to get an idea of what those rates are, please reach out to me. Longer than 30-year term. So this is something that I've been talking about for a long time, right? How do we make payments more affordable, especially with the market that we're in? First thing that I thought they were going to do is extend the terms of the loans to 40 years. But can they do that now in an environment where we're seeing obviously huge inflation going on? If they boost terms to 40 years, what's that going to do? The buyer demand is going to go up and home values are going to continue to go up, aka, affordability. I just don't see that being something they want to do, right? That may not fight inflation, that may increase inflation. Assumable mortgages, that always depends on the product that you're doing. I can't tell you who's going to, let's say, start offering assumable mortgages, but it would depend on, who the investor is and so on and so forth. I can't really get into detail about that. River, Choi asked about interest rates inflated to 6%, which that's where they're at today, if not a little bit higher. And I said, how about even better? How about my prediction for rates over the next 18 months? So interest rates inflated to 6% obviously does affect buyer affordability. Payments have gone up on houses as well. So my predictions for the rates for the next year, the Feds aren't going to back down. The Feds are going to continue their increases throughout the year. And I think for the next 18 months, we are going to see an increase. I would not be surprised if we see 7% by the end of the year. I feel we will still start to see some tapering back on those rates. In about 18 months, we may see some things start to get a little bit better when it comes, and lower. So that'll give people the opportunity that are purchasing now the ability to refinance in 18 months and get a little bit more of an affordable payment. Danielle goes, which do you think will hit 8 first, gas prices or interest rates? Danielle, I think gas prices are going to hit 8% before interest rates, to be completely honest. But I hope that neither hit 8%. It's going to create more problems. It's already hard to fill up a gas tank. I get that. So this is ridiculous. I want to take a vacation in my RV and I can't even fathom buying a full tank of diesel in there. Rachel goes, when will I be able to afford a home? Rachel, we need to talk. You make great income. To be honest, I think that you can actually qualify for one now. It's whether or not you want to. Jeanette, how about current home values and how long will that last? So home values have already peaked, Jeanette. If you were looking to sell your house, the best time to sell the house would have been 2 months ago. So price reductions, corrections, things like that, we're already starting to see. I'll give you an example. I had a good friend of mine actually get into contract on a house in our area for $860,000. Well, fire insurance came up and was very expensive, and they decided to back out. We looked and followed that property, and that property just got accepted at $775,000, almost $100,000 reduction in price. I can't promise that's going to happen with every property, but we're expecting a 10% decline in home prices, and we're already starting to see that based upon market time, things like that on properties, how long they're on the market, how many offers are being made day one. How picky buyers are, how greedy sellers are. Okay. We've got a few more replies in that. Let's see what's going on. Oh, this is where we've got some people arguing different things about what's going to happen in 08 and what happened in 08 versus what's going on now. So I'll touch on that briefly because I was in the business in 2008. I actually started in this in 2006. So I saw the peak and then all of a sudden crash, boom, right? Why did that happen in 2008? That was mainly due to the bad loans, which Steve Wiley is mentioning, like the option arms, the interest only, the NEGAM loans. The people that qualified for loans back then technically should not have. There were a lot of stated income products. There was a lot of 100% financed products. So the people didn't really care too much. If they got the house and didn't have to put anything down, what's the problem with, let's say getting rid of it, or filing bankruptcy, foreclosure? They don't have a vested interest like they do today. So Steve, you definitely can argue your point. Today, the loans that people get are much more difficult to get. We have to pretty much almost get your blood type in order to give you a loan today. So Steve, you're right there. But River, you are also correct, because we've got home prices today that are very similar, actually higher than 2006. So I'm going to be showing a graphic at the end of this video which goes over the price points from different time periods over the past, about decade. And we'll see, affordability. And obviously affordability plays a big factor. How many people can afford $1 million house right now with how high rates are? We'll go over that. All right. Heather, do we expect another bubble to pop and house values to drop? I think we just addressed this. Yes, I do think home values are going to go down. I'm going to show also a graphic which shows some of the most impacted areas that we believe are going to be most impacted across the country. Okay. All right. I did mention that we've got a lot of people from different markets here in this thread. I do quite a few loans for people across the country. If you throw a dart on the map, I can pretty much do a loan there. There's a very few states that I can't do a loan in, which is why I've seen what's been going on nationwide versus just locally. And the same things that have been happening locally have been happening in most markets nationwide. So if you're in California listening to this, we are not the only ones. I've seen people move out to Arizona to help, let's say, get into a more affordable area than San Diego, and they've ended up spending the same amount of money that they used to spend in San Diego in Arizona. But San Diego may be more expensive than what they were paying back then. All right. Inventory. What's my thoughts on that? Inventory is a tough one. The people that are going to need to sell are going to sell. Relocations, things like that. People will sell the houses. Investors, good time to sell homes right now, right? If they want to beat any kind of decline in values, it may be a wise time to consider selling. Would have been wiser 2 months ago. So my thought is on that, people have 2% interest rates, 2.5, 2.625, 2.99. Who's going to sell a house that they're living in that they have a 2.99 rate on? Also, the property taxes are usually lower than if somebody was to purchase that same house now. So what incentives does it give that person to sell a home? Again, it's going to be more that need versus want. Okay. Robert, I'm assuming second mortgages went up beyond what we had previously talked about. Mentioned to him, second mortgages are not necessarily my specialty unless we're combining it with the first lien. But we are potentially releasing a product that is a HELOC that will be, I'm assuming, bank driven. Because we are an FDIC bank, we're backed by Plains Capital, and they give us some nifty programs, just like the ARM that we've launched. It's only available to prime lending. Jonathan, can you do a section about the new 80/20 interest-only stated loans? No, my friend, those don't exist, and I know you know that. Carlos, status of the rental foreclosure market, anticipating, unfortunately, a lot of clean out work myself. Carlos, you're a good buddy of mine. You do a lot of junk removal for flippers, for everybody, for community. You're an awesome person, I have to say. In regards to the status of the rental market, I think landlords, the ones that are aware of what's going on, unless you have a really nice one, are going to increase rent the maximum amount that they can do. In our area here in San Diego, it's 10% annually. They cannot increase your rent more than 10% per year, but I have a feeling that 10% is going to apply for a lot of people. You got a cool landlord, you lock in your rate, hopefully it doesn't go up. And yeah, you may get a lot of clean out work. Foreclosures aren't going to hit yet. I don't feel like, there's some people that can argue this opinion with me. There are people that took COVID forbearance, but COVID forbearance, people, the government comes to help out homeowners. So, they're going to do everything in their power to keep that homeowner in the house. So waive the payments, tack them on to the end of the term of the loan. I don't think we're going to be seeing as much foreclosures for a while. That especially comparison to what we saw in 7, 8, 9, 10, 11, 12. But hopefully you do get a lot more clean out work. How to take a loan on your existing equity before it drops, and what to expect for interest rates to do so. John, JP, I should say, what up? What's going on, buddy? So this, again, is in the HELOC arena. HELOCs have different qualifications than what I typically offer as a product. So I can't really comment on what the interest rates are going to be. But if, the only reason I would suggest tapping into your equity right now is if you have something to do with that money that can gain you more capital than, let's say, taking the money out and paying a loan against it. Typically HELOCs are interest only, so this is going to be a monthly payment. So can you make more with your money than, let's say, it just sitting in your house? You've got to have a strategy to do that. Dan, this is a hot topic here. Implications of MBS hitting no bid last week and essentially all-time lows, lower than '08. All right, so we know that the MBS hit a no bid last Friday. What does that mean? How does it impact, let's say interest rates, market, future, things like that? So Dan, as most of us know, the feds came in and they basically bought up a large pool of mortgage-backed securities. And why did they do that? They did that to keep interest rates lower, right? Essentially artificially low to help the economy, help things, go on, help people purchase a home. The feds have stopped purchasing mortgage-backed securities, so they're no longer buying them. So what that leaves that up to is private investors, and private investors are heavily risk-based. So if they see it a risk, because of course last week the Fed meeting had not occurred, things like that, they're not going to be buying up any mortgage-backed securities due to risk. What does that mean? That could mean that interest rates will go up. Very short and sweet. Interest rates could definitely go up. So, essentially the market is feeling the squeeze. Everybody's feeling this right now. It's not just me being a pretty good originator. It's a lot of people. Cam, I'm sorry, I can't answer your question. I'm not exactly sure the difference between the economists that you're mentioning, as much as I would love to comment. Mo, somebody that's very, very close to me, somebody that I've worked with for, more than a decade, longer. Mo and I have worked together. Said, in a market like this, when does refinancing make sense? Are there areas of the country? Let's go by line. So in a market like this, when does refinancing make sense? I think it's at a need basis right now, Mo. For example, we've got quite a few people that we have helped save their homes over the years, and they have those second mortgages that we talked about. We're still helping those people. Those people need to refinance. I have clients that bought properties with other parties, let's just say other investors, and those investors are wanting to cash out on their investment now. So the remaining borrower that wants to keep the house is now having to refinance, pull out cash, and pay off that remaining borrower. That's a couple different circumstances, but there are many. Sometimes consolidating debt can make sense. Interest rates on mortgages still are, I hate saying this, low, but they're normal. They're normal. We were just spoiled over the past few years with the 2% rates. These are going to become the new norm. And hopefully we'll see a little reduction in more than a year is my expectation. Are there any areas of the country where you're still lending that properties are in line with reality and affordable? Yes. I actually do, as everybody knows, quite a few transactions across the country. There are many areas that are still affordable, and also many that are not. It's hard to say California is affordable. It's not. Texas, it's not. Arizona, it's not. Washington, Oregon, it's not. And then I have an infographic that I'm going to be bringing up on this screen that also shows different areas that could be impacted heavily by what may be coming. Again, may be coming. So we'll go over that. But yeah, no, I see good investments in Cincinnati, Ohio, Nebraska. Let's see, what's some good other ones? Georgia in some areas. Kentucky, Montana. There's a lot of areas that have not been impacted heavily like some have. Some very populated areas. All depends on what your goals are. Graham goes, what is par no points today? FHA versus San Diego versus conventional. Oh gosh, I don't have anything priced out today. So we'll have to get back to that. Graham, I'll let you know. My expectation would be for a conforming loan, high FICO, 20% down or less. 25% down, you'll get better rates. 20% down, you're probably looking pretty close to low sixes with no points. 6.125. I don't think we've reached, back to the fives. I think we're in the sixes still. Same thing with jumbo. FHA, I locked one about a week and a half ago at 4.75. Had, I want to say 1.5 in discount points, if not a little bit less. And that was pretty attractive. I think we are down to the low 4.99s right now. Maybe 5.25. 4.99 to 5.25 would be my best guess at par. Great question, Graham. All right, you guys, let's end this video with a comparison, a historical comparison to historical data to today's market. All right. So let's take a look at, I'm going to see if I can make this a little bit easier for you guys to read, but maybe this will work. Okay. So let's go to 1990 first. So home value, I actually did this comparison on my house, by the way. Home value in 1990, 150,000 estimated, because I can't confirm, but I'm assuming in 1990 it was worth about that much. Interest rates, let's just say they were extremely high. Let's say they were 12%, because the argument today is that 6% rates aren't affecting payments that much, and it's the new norm. We're going to look at that. So your $150,000 home purchase, I did a loan amount of $150,000 too. Your principal and interest $1,542 with property taxes, with insurance, assuming no mortgage insurance. The total payment would be $1,784 and 17 cents. Now back then, in 1990, it was a little bit more difficult to qualify for a mortgage. They were doing different debt ratio requirements, and you're going to see minimum income to qualify for a program like this, $5,755.38. Because that was, again, it means it was a little bit difficult to qualify back then. 1990, all right? Who wouldn't want to buy a house now for $150,000? I'm telling you, I would. 2012. All right, so 2012, we hit the rock bottom again. It was from 06, the peak, 7, 8, 9, 12 was the rock bottom. And then it started to climb up from there. So I did a rock bottom estimate, 2012 on my house. It was worth $288,000 at 5.25% rate. Principal and interest, $1,590.35, about the same as the 1990. You can see because the interest rate was lower. Total payment with tax and insurance, obviously taxes have gone up, $1,975.35. Was a little bit easier to qualify for a mortgage in 2012. The debt ratio requirements were less, or higher rather. So the minimum income to qualify for that house was $4,202.87. If you have more debt, that would increase that number to qualify. Skip on to 2018. 2018 home value $530, interest rate 4.375, some decent rates back then. Principal and interest $2646.21. Total payment $3,063.29. Minimum income needed to qualify for that is $6,517.63 a month. Okay, so you're looking more at like $75,000-$80,000 a year with no additional debt or very little to qualify for this purchase back in 2018. Here we go, 2020. Home value $800,000. I looked on Zillow. Zillow was saying $800,000. Okay, so I bought my house for $530. Now it's worth $800. I need to take a sip of coffee for that because it's a lot of equity. Today's rough interest rate 6.125. Principal and interest $48.60.88. Here's another big change. The taxes $833.33. Okay, you see the difference between the tax rate in 18, 12, and 1990? That also affects the payment. It's not just the interest rate. Now, there are some states where the taxes don't change from property to property, but they're all still going up as well. So we've got a total payment here with insurance, $5,779.21. And let's scroll down just a little bit to see how much income you would need to qualify for that, right? $12,296.19 a month. How much is that? About $140,000 a year? Roughly about $140,000 a year. So in order to qualify for my same house, $800,000, you've got to make about $140,000 a year. That's almost double of what it would be back in 2018 here, if you can see at 65.63, almost double. Not only that, but if you look at the payment, it's almost double as well. Okay. What's the lesson behind this? Something's got to change. Interest rates, something's got to change either there or home prices. Again, let's say it's a 10% decline in value. If you're looking to buy the house as a primary residence and you're going to stay there for 5 years, it's always a good time to buy. If you're looking to buy something to flip or keep for a very short period of time, you're not going to be in the location for long. Maybe it's a more wise decision to rent, continue to rent, whatever's going on. But if you want to stay planted, I suggest still buying. You'll be able to refinance into a lower rate, which essentially will get your payment lower when they do go down. Disclosures here, of course, have to show those. Obviously, these rates are estimated at this point and they are subject to change. All right. Here's a fun one that I wanted to go over that was shared by one of my good friends on Facebook. And what are the top 10 most overpriced housing markets in the USA right now? Let's see what comes in, right? California's got to be on the list, you'd think, right? So number one, and let me first go over this, okay? So there's a lot of areas in California that have shot up so much in value. For example, Joshua Tree, right? It's a little retreat area in the middle of the desert, and home values have skyrocketed because everybody can Airbnb those properties. But there's no economy out there. There's no places to work. So how can that increase be sustainable? I mean, if you look at the chart, it's a slow increase and then all of a sudden goes skyrockets, right? It just does not make sense. So in areas where you don't have a large economy, you don't have a lot of jobs, second home areas, Big Bear in California, snow areas, snow bunny areas, wherever those are, any vacation areas that do not have a good economy behind it, a good workforce, we're going to see values get impacted, I feel. So Boise, 72.64% overvalued is what the estimate is. Austin, Texas, everybody's moving to Texas, 67% overvalued. Ogden, Utah, 64.73% overvalued. We're really high numbers here. Las Vegas, Nevada. You remember when houses out there were just desolate? You could go into like ghost communities. Can't do that anymore. None of that's around. 61.48% overvalued. How good's the economy in these areas, right? I mean, Texas you would think would be good. Vegas, maybe not so much. Maybe there's not as much job opportunities unless you're working at the hotels. I know there's a lot of other stuff going on out there. But I just don't know that market as well. This one surprises me. Georgia, Atlanta, Georgia. Although it is a very populated area, it does have a very good, economic, let's say, standpoint when it comes to jobs. It says it's 0.01% overvalued. That's actually surprising to me. Phoenix, Arizona, 57.94. Provo, Utah, 57.02. Fort Myers, Florida, 56.26 overvalued. A lot of people pronounce this one different. Is it Spokane or Spokane? I'm not even going to start there. Washington, 56.25% overvalued. Salt Lake City, Utah, 55.75% overvalued. Why don't we see California in this mix? To me, I would think we would see a little bit of California here. I would think we would see more Florida. But as you can see, some of these areas are some very a lot of activity going on in those areas. All right, so this is the gist of the video. I hope I answered everyone's questions to the best of my ability. Of course, if you have any additional questions, feel free to ask and post on the comment that I'm going to be releasing this on. I really appreciate you guys watching this video. Hopefully, again, you learned something. And if you do go to my YouTube channel, please do like, subscribe, and allow for the notifications. I really appreciate it. The more followers I can get, the more people I can impact. Thank you so much, guys. I hope you have a wonderful weekend. There's a holiday coming up this Monday, Juneteenth. It'll be my first one, so I'm looking forward to that too. And other than that, you guys have a great day. All right. Thanks. Eric Sandstrom, Prime Lending. Goodbye.